Welcome, everyone. In our journey to becoming really effective business leaders, there are a handful of core concepts that, once you get them, they totally change how you see a business. And today, we're going to dive deep into one of those, unearned revenue. Now, I know, it sounds like some dry, boring accounting term, but trust me, it's so much more than that. This isn't just about balancing the books, it's about understanding the promises a company makes to its customers, and more importantly, its ability to keep those promises. Getting this right will fundamentally change how you look at a company's health.
So here's our game plan for today. First, we're going to start by smashing a really common and honestly a very dangerous misconception, that cash is the same thing as revenue. It's not. From there, we'll get into what unearned revenue actually is, and we'll see it as a promise, not just a number. Then we'll get our hands dirty with the mechanics, the journal entries, how it all works on paper. But theory's no good without practice, right? So we'll apply it all to a case study, Campus Crate, to see how this stuff drives real-world decisions. We'll also cover the common mistakes students make so you can sidestep those. And finally, we'll zoom out and see how this one little account can actually be a huge signal about a company's future. It all builds together, one step at a time.
All right, let's jump right in with maybe the most important distinction you'll learn in financial accounting. It's an idea that feels a little weird at first, because in our day-to-day lives, cash is king, right? The money in your bank account, that feels like the measure of how you're doing. But in the world of business, which runs on what we call accrual accounting, thinking that cash equals success is a huge mistake. It's a trap that has actually led some really well-funded companies straight into the ground. We have to learn to separate the moment you get cash from the process of actually earning it. They are two different things.
Okay, let's make this real. I want you to imagine you're the founder of a brand new software startup. It's January 1st, launch day. You've been working for months, and boom, it's a hit. Customers are flocking in, prepaying for annual subscriptions, and $1 million in cash lands in your company's bank account. You look at that balance, it's incredible. So let me ask you, are you rich? Did your company just make $1 million in revenue on day one? The gut reaction, the temptation is to scream, yes. But the right answer, the disciplined answer that will keep your company alive for year two, is a hard no. Not even close.
This slide really breaks down that core difference. Over on the left, you've got cash. Think of cash like a snapshot, a photo. It's just how much money a company has at one specific moment in time. It's an asset, and it lives on the balance sheet. But over on the right, that's earned revenue. Revenue is more like a movie. It tells the story of your company's performance over a period of time, a month, a quarter, a year. It's what you've earned by delivering your product or service, and it's the top line of your income statement. The whole point of accrual accounting is to build a solid bridge between these two things, to manage that time gap between when you get paid and when you actually do the work.
So that big distinction leads us straight to our main topic today. I really want you to reframe how you think about this. Unearned revenue isn't just some random accounting term. It is the financial version of a promise. When a customer pays you upfront for something you haven't delivered yet, you haven't really made a sale. What you've done is you've entered into a contract. You've taken on an obligation, or as we say in accounting, a liability. You literally owe them something.
Okay, so here's the formal definition, and every single word here counts. Unearned revenue happens when you get paid before you've earned it. That's the trigger. And what does it create? An obligation, a liability. It's kind of like a debt, but instead of paying it back with money, you pay it back by doing the work. And this brings us to the most important part. Revenue is recognized as the services provided. It's not a one-time thing. It's a process. It's the slow, logical conversion of that liability into earned revenue, month after month as you keep your end of the deal. This is the very heart of how subscription businesses work. This lays out the whole life cycle of that promise. Let's walk through it. Step 1. The customer pays you. Your cash goes up, great. But at the exact same moment, step 2 happens. A liability is created. We call it unearned revenue. You now have an obligation. Then in step 3, time passes. You deliver your service, you do the work. Each month you fulfill a little piece of that promise. And that action, fulfilling the promise, triggers step 4. Revenue is finally earned. Only then, at that point, can you reduce the liability and recognize the revenue on your income statement. See how the cash event happens just once, right at the beginning, but the revenue event happens bit by bit over the whole service period?
All right, so we've got the concept down. Now let's translate this into the actual language of accounting, the journal entry. This is where we see exactly how these events get recorded in a company's books. For a lot of students, this is where the light bulb really goes on and the theory starts to feel real. We're going to use our debits and credits to tell the story of our case study, Campus Crate.
Okay, let's break down this first transaction. On January 1st, Campus Crate gets a $120 payment for a full year of snack boxes. So, first thing we do is debit cash for $120. Remember our rule, debits increase assets. Cash is an asset, so this shows our bank balance just went up. Perfect. Now for the other side of the entry. We credit unearned revenue for $120. Unearned revenue is a liability account, and liabilities are increased with a credit. So this entry perfectly captures what just happened. Our cash went up, but our obligation to the customer also went up. We're officially saying on our books, we owe someone $120 worth of future snack boxes. And notice what's missing. There is zero revenue recorded here. None.
Okay, now let's fast forward to the end of the month, January 31st. A month has passed, and we've shipped out that first snack box. We have now fulfilled 1/12 of our promise, so we have to update our books to show that. We do this with what's called an adjusting entry. First, we debit unearned revenue for $10. Why? Because debits decrease liabilities. This entry correctly reduces our obligation from $120 down to $110. We only owe 11 more boxes now. At the same time, we credit subscription revenue for $10. Credits increase revenue, so this entry is where we finally, formally recognize that we earned $10 in January. This $10 is what will show up on our January income statement. And we'll just repeat this exact same process every single month until the whole $120 is earned, and that liability is back to zero.
So we've covered the mechanics, the debits and credits. But like I said at the beginning, this course isn't about making you a bookkeeper. It's about making you a great decision maker. So we have to ask the big question. So what? Why does this matter so much? Let's put on our manager hats at Campus Crate. We're about to see how getting this one concept right can be the difference between steady growth and complete disaster.
This chart shows you the two different realities a manager could be looking at. That bar on the left, that's the cash view. It shows $120. It's exciting. It feels like a huge win, but it's an illusion. The bar on the right, that's the accrual view. That's the economic reality. It shows $10 in earned revenue. That is the true sustainable measure of how you performed in January. That other $110, that's not your money yet. It's a liability. It represents the work you still have to do for the next 11 months.
Now, let's play this out. You're the manager. You see that $120 cash come in. You mistake it for revenue and you think, wow, we're crushing it. Let's hire another person. Let's give out some bonuses. You've just locked in higher monthly costs. Then February comes along, and let's say you don't sell any new annual subscriptions that month. Your cash-based report would now show zero income, but you still have to pay that new employee's salary. You've made long-term commitments based on a short-term, misleading number. This is exactly how companies with money in the bank go out of business. The accrual method gives you a stable, true picture of your business. $10 earned in January, $10 in February, and so on. It lets you match your spending to your actual performance. That's how you build a healthy, sustainable company.
All right, as you move on from this class into your careers as managers, analysts, and entrepreneurs, you're going to be looking at financial statements all the time. So I want to take a minute to go over the most common mistakes I see students make with this specific topic. Think of this as a checklist of traps to avoid, both in your coursework and out there in the real world.
So let's run through these. First, and we've hammered this point home, don't confuse a big pile of cash with a big pile of revenue. They are not the same thing. Second, always remember unearned revenue is a liability. It's something you owe, not something you own. Third, those monthly adjusting entries, they are not optional. If you forget to do them, your financial statements are just plain wrong. Fourth, base your spending decisions on your earned revenue, not your cash balance. And finally, never forget that a big unearned revenue balance means you have a big operational job ahead of you. You've got to deliver all those goods and services you promised.
Okay, for our last section, let's zoom out a bit. Let's move beyond the rules of accounting and into the art of financial analysis. Once you really get the mechanics of unearned revenue, you can start using it as a tool, not just to understand what a company did in the past, but to get some really powerful clues about where it's headed in the future. It's all about reading between the lines of the financial statements.
So I'm going to leave you with this final thought, this challenge. The next time you're looking at the balance sheet for a company like, say, Netflix or Adobe, find the line item for unearned revenue. If you see that number growing quarter after quarter, that is a fantastic sign. It tells you that more new customers are signing up and prepaying for the service than are leaving. It's a signal of strong momentum. It's a pipeline of predictable revenue that's already in the bank. In a way, it's a measure of the market's trust in that company's future. And your job, as a smart analyst and a future leader, isn't just to see that number, but to truly understand the powerful promise that it represents.